Well, U.S. financial regulators took action this weekend to stabilize the banking system. That's after the sudden collapse and seizure of Silicon Valley Bank. Now, the Federal Reserve, Treasury Department and FDIC assured all customers will have access to their money held at the bank starting today. And the same goes for depositors of Signature Bank. Now, the sudden failure of SVB took place after it couldn't meet the demand of panicked clients as they tried to withdraw $42 billion from the bank. President Biden made remarks this morning to the American public, emphasizing the U.S. banking system is safe. But what do markets have to say? Here to discuss is Kathryn Rooney, Vera, Bulltick Capital Markets Head of Global Macro and Chief Investment Strategist. Good to have you on the show. Obviously, been quite the roller coaster here. You weren't sure if markets were going to buy what they were hearing from the government on this. But we are seeing, as we've seen, all three major indices now positive. So if this isn't a systemic issue, as we did see in 2008, how would you characterize what we're seeing at the moment?
Well, it's definitely part of it has to do with the Fed having increased rates 500 basis points over the course of about 12 months. And banks and credits, issuers, especially high yield or junk issuers, those that have, such as in the case of Silicon Valley Bank, poorly managed their assets and liabilities and took on too much debt or made themselves vulnerable to the tech space. Again, in this case, I think that's exemplified. They're going to face fragility and defaults. And that's part of the economic cycle, Rachelle. We've had a Fed that has kept rates artificially low for an extended period of time. The Fed also back in 2020, and I think SVB probably believed this, said that the inflation was transitory and that we shouldn't worry and that inflation wouldn't get out of hand. We really wouldn't need to worry about rates going much higher. So what happened? We have this asset liability mismatch rather, and it has been massively a losing proposition, let's call it that way, for a lot of these junk entities. And I think we should expect to see more of that in the small bank space, as well as in emerging market issuers and high yield names. So let's expect that. That's part of the cycle. And that's part of a Fed that has increased interest rates so dramatically after keeping them so low for an extended period of time. I don't think it's a systemic risk to the financial system. We should not compare it to 2008. The conditions are decidedly dissimilar. They're not the same. And let's face it, we could have a FDIC that backs up all the depositors. Yes, but we're not talking about bailing out, corporate execs. We're not talking about bailing out credit bondholders or equity holders. This is a backstop to the deposits. And I think that they did the right thing in doing so.
But I mean, when you see how fast the tech space had grown, especially during those historically low interest rates, you saw SVP deposits tripling between 2019 and 2021. Right. Should some sort of alarm bells have gone off when you do have so much exposure to tech, which is so sensitive to interest rates? Should red flags perhaps not have gone up a lot sooner?
Yeah, they probably could, but it's so easy to look back and judge. Right now we have alarm bells going off and people are underestimating the risks. I mean, you hear a lot of economists talking about soft landing when really I think it's more of a pipe dream than anything else. So at every point in time, Rachelle, we have underestimated risks. And we in the future could be looking back on now and saying, how did we not see this, right? You have an equity market that's trading at 18 times forward earnings when we're on the precipice of recession. We have a Fed that's going to still have to continue hiking rates because inflation is 3 times the target. Yet Fed fund futures are expecting no further rate hikes from now through year end. Yes, in part because of SVP, but they're expecting now cuts. So I think there are some massive dislocations in the market right now that are being underestimated. And that's why, Rachelle, I am recommending to our clients, both institutional and retail, ever since the beginning of the year, honestly, that they park some cash in instruments that I think are pretty juicy right now. We can look at commercial paper or T-bills that are yielding around 5%. Not today, they were. They've fallen slightly. But certainly that's risk-free assets that I think compare favorably, Rachelle, with the equity risk premium, the risk that you're taking to assume equities. I think it's favorable for cash equivalents, and fixed income instruments at this juncture.
And you raise a fair point. Obviously, a lot of red flags going in opposite directions, and markets don't seem to be pricing in that risk as well as they should. I want to ask you about global ripples, though, coming from this fallout from SVB. I mean, we saw the UK approach, HSBC, buying the UK arm for £1. So what are the expectations for global ripples here? How contained do you think this should be?
It's a good point. I think that that it should be relatively contained, but as I said, the bad apples I think are going to get shaken out, which means paper issuers, corporates, banks that are financially unstable and unable to weather the storm of massive increase in interest rates. So I do expect, and I reiterate, this is a natural part of the economic cycle. One should expect entering into recession or in recession, which could perhaps be precipitated by Fed rate hikes, one should expect there to be difficulties with repayments from some of the lower quality issuers. So that hadn't happened yet. It's starting to happen, and I don't think we should discard the possibility. In fact, I think we should fully expect that to continue to occur. And I don't think that the Fed should backstop everyone, and they probably will not. There will be a lot of small entities and perhaps junk bonds that will default or go under. And as I say, that's part of the economic cycle. I do think that there will be opportunities to enter. There are names, there are banks in Europe, for example. The baby is going out with the bathwater here. You have everybody falling out of bed. So I think it's a good opportunity for investors to look for names that are structurally sound. I mean, a lot of that money, Rachelle, that is being, backstopped in terms of the deposits has to find a home somewhere. So it's more likely than not going to benefit the big banks that are more healthy and financially sound.
And while it does raise that moral hazard question is who should be getting the special treatment, who should be getting the backstops and not, also another focus is what this means for the Fed. Most think they're going to keep the trajectory, that they're going to continue with the rate hikes. But what's your take? Because some people are expecting perhaps a pause or waiting for the medicine to kick in once we have something like what we've had with SVB. I
think the market is in for quite a shock when it sees that the Fed perhaps does stay higher for longer, but then resumes rate hikes, not rate cuts. Why? Because inflation is sticky. You have the sticky component of inflation from the Atlanta Fed still moving higher. You have core inflation, which is X energy, X food, and X shelter costs, also sticky and accelerating. So inflation has some real concerns, and I think it should concern the Federal Reserve. The labor market remains overheated. So I think the Fed's going to continue to hike, perhaps not in this meeting, down the line, once we get some stability on this financial front, which is the current panic. But I do suspect the Fed has to return to basics, back to basics. They have a dual mandate, full employment, and 2% inflation, and that is their target. They must get there.
Certainly doesn't help coming off of one black swan event then to have another also roped in as well. But a big thank you there to Kathryn, Rooney, Vera, Bulltick Capital Markets Head of Global Macro and Chief Investment Strategist. Thank you for your time this morning.
Thank you.